Welcome, everybody. This is John Wilson of propertyinvestmentblueprint.com. And today I'm excited to be speaking with property accountancy and tax expert Simon. Sorry, Simon. I meant to ask you, how do I pronounce your name before we started?
A lot of people, John, to be honest, call me Simon M. For everyone listening in, it's Misiewicz, but if you haven't had a couple of glasses of wine or beers, then Simon M is perfectly fine with me.
Okay. Simon M then it is. Simon M of Optimise Accountants. So Simon, welcome to the broadcast today.
Thank you. It's great to have you. It's great to have you on board, and really looking forward to hopefully delivering a good session for you guys.
Excellent. Okay, well, I know you've got a bit of a presentation for us that we're going to follow, but yeah, I mean, if you want to start off with just telling us a bit about your story, like, you know, which came first for you? Was it accountancy or property investing, and what inspired you to specialize in property?
It's a good question, and I think I can go through my slides as we go through. I'm just going to get rid of these slides if that is okay. For anyone that's kind of wanted to know more about what we talk about today, we do have a series of articles that you can see on our website, which you can visit www.optimiseaccountants.co.uk and visit those articles whenever you want to. As we go through this, there'll be a bit of Q&A which John and I will break up from each of our slide points, and we'll hopefully John's got some Q&A which is from you guys anyway, so I'll be happy to answer those as we go through the slide deck. But as John said, you know, what is my background? What came first, the chicken or the egg? And for me, it was, I'm just going to move this so you can see the titles. So I think my camera is in the way here, so I'm just going to move that over here. There we go. So I was an employee a long time ago, business consultant. I worked for many blue chip companies like Boots, Imperial Tobacco, Virgin Media, mainly as IT, not IT consultancy, but IT management and infrastructures and putting in finance departments across the globe. And it meant that I was traveling, you know, from one country to another on a frequent basis. And I didn't really want to be that employee for long. So I started to invest in properties. As you can see there, I had quite a few single let properties that were generating a huge whopping 6% return on investment. And most people would laugh at that now when you're in the property game, which, you know, if you read and listen to what John's telling you, 6% is laughable. But at the time, that was quite impressive for me as an employee. And I think that came first, really. I wasn't in property tax to begin with. I had an accountant who's a good friend of mine still, who did a lot of the work for me, but I was nitpicking at certain stuff that he was doing for me on my tax return. It's an interesting conversation because it's, you know, it's two friends, but it is involving money. And as I was scrutinizing stuff here, he said, look, why don't you just do it yourself? You know a lot more about it than I do. So lo and behold, I started doing, I did some education courses myself. I ran education courses as well. I've been an author all the way through this journey. And I was just picking up clients here, there, and everywhere. I was just writing about my own stuff in terms of what I was doing in the property game. And when I was talking to people at network events, all of a sudden, I had 100 clients in my own business. So I gave up the consultancy work, went into the accountancy business as a property tax specialist, and carried on investing in my own properties. And because of education, I think anyone listening in, I'm not an educator in terms of the property investing. I'm an educator really in tax and giving people wealth and tax planning advice, really. I'm not a person that you can turn to and say, well, tell me how to invest in properties, in rent to rents. And I just wouldn't be your best person for that because it's just not my area of expertise. I probably could do it myself. But as this slide will show you, what we now do is that we invest in properties that we can convert. So we'll take a big old house, and then inside that house, we take all the walls out and start afresh. So we will basically create miniature flats inside of this property. And for me, it's better than HMOs personally, because it's very time consuming in terms of keeping tenants happy, tenant checking in, and spare room answering all the time. For me, that was a little bit too noisy because of Optimise Accountants. That was growing throughout 2015, 2016, and if I'm honest, I was up and down the country networking. So these pods, I call them now, these little flats, if you like, in these dwellings are a lot better for me because they're quieter. They're almost like single lets, but they're miniature. But they will do for people wanting to get out of their parents' home, or if people are split up, or what we do find interesting is that we're servicing people that have got they've got a home in London, but they want to they've got a contract in Nottingham, maybe as a doctor or a solicitor or a business consultant, or you name it, builder even, albeit we do stay with the white collar workers to keep that niche going. And we do tend to find that that's our kind of marketplace. And we've been doing really, really well with that. So 15-25% return of investment. We're doing that very well. And just to re-echo the points I made earlier about, whatever John is telling you about, education and improving your strategies, make sure you do listen, because I think it's about enhancing your knowledge, taking that step further, and developing it. And I guess that gives me a bit of a summary of where I've come from to date.
Fantastic. Yeah, no, I like that idea of the pods, Simon. It's not really something. I mean, I guess it's a bit like the old concept of the bed sit, right? But something much higher class, right?
Yeah. So interestingly enough, we will charge for one single flat in Nottingham around about £650 rent per month, and that includes bills. So don't get me wrong, that's not just a net rent.
Mm-hmm.
But these pods, we have one boiler system, we have one fuse box, we have one water system. So we don't have multiple charges for gas, electricity, flat rates. We just have one.
Yeah.
So the bills are really, really small. The property value itself, aren't that great. The mortgage values are not that great. So really, we're getting good rental income and rental cover on all of these properties, if I'm honest.
Mm-hmm. And you being the tax guy, are there particular tax advantages for this way of doing things?
Yeah, absolutely. That's a good point, actually. The reason why we moved into this kind of thing, if you take a one dwelling, like a single house, and then you carve it up into a HMO or a bed set or multiple dwellings like we have here, then the refurbishment costs of VAT attributed to that refurbishment cost is reduced from 20% to 5%. And that was a huge amount of saving that we were making on the refurbishment. 15%, and any saving in any capacity is great. But we were spending over about £125,000 on this refurbishment on the picture that you're seeing now. And I think we saved about £10,000-15,000 on VAT alone.
Wow, that's fantastic. Great.
So shall we move on?
Yeah, please.
Okay, so what I thought we'd do then is I'll go with Python slide. For whatever reason that's not worked out, so I'll ignore my team. But let's go into the basics really, in terms of what I believe that people that are pursuing the rent to rent, it's about getting the basics in place. It's not just about one strategy. It's looking at your finances as well as your tax planning at the same time. And the one thing I would say is basic administration. And to be fair, this can be applied to any type of property strategy that you follow. But again, it's all about the rent to rent for what I'm trying to deliver here, is to keep a separate bank account for your property business. And what I mean by that is making sure that all of your rental income and the cash you receive from your tenants is put into one property bank account. And the expenditure, so expenditure for your refurbishment, your gas, electricity, I guess, John, from your side of things, most people that are doing rent to rent, are they doing HMO rent to rents?
Yes, I would think so. Yeah,
Yeah.
those are the main ones that I hear about.
Okay. So that's really important because the big thing I would say is you're paying for all the utilities, whether you're using BT or Virgin or any other type of telephony and broadband, you will have all that expenditure going out. And I think it's really important to make sure you have that in one bank account. The big thing for me for that is because you want to know if my bank balance is going up, then you do know that that is a successful business so far. If the bank balance is constantly going down month in, month out, then you should know that you've got a problem. So immediately by just looking at your bank balance, it will tell you, am I doing well? Am I not doing so well? And that can be all tell from your bank statements. The key thing for me, though, is making sure they keep receipts. Oh my gosh, have I had conversations with clients on this one? You know, people are saying nowadays, well, I've moved over to Zero QuickBooks. I can scan my receipts and just chuck my old receipts away. And surely that should be okay. And I'm thinking, well, hold on. HMRC can investigate you up to 6 years. Imagine that you move from Zero to QuickBooks or vice versa, or any other new system that comes on the marketplace. You've all of a sudden lost the electronic receipts that you have stored on that system. And if HMRC come and investigate, they're not going to take as an excuse of, well, I changed over to a different bookkeeping system, so I can't provide you with those receipts. They're not going to accept that as an excuse at all. So what I would always say is, if you want to keep electronic copies, then do, but also have a backup system in place, whether you want to store your receipts onto Dropbox or something like that. So at least you've got a two-way backup of all your receipts. I don't know, it'd be interesting what you do, John, for your particular transactions, because you're obviously away from home. So how do you keep stuff together?
Wow, yeah, great question. It's in a variety of different places. My accountant was actually trying to get me to move to Zero a while ago, and I never actually did it. Maybe I still should, but yeah, I end up with a bunch of paper stuff that comes to my UK address, and
Right.
whenever I'm back in the UK, I kind of rationalize that and file it away, and that stuff does get kept. You know, I make sure that the anything, you know, paper is kept for 6 years at least,
Mm.
and then the rest of I've got a lot of stuff that ends up in my email inbox, which that's another kind of place where everything kind of congregates as well. So
Yeah.
two places really.
Yeah, I think administration is always a bane of people's lives, isn't it? It's
Mm.
how do you got so many suppliers that will send you an email with your bill on it. Some electricity suppliers are now saying, well, actually, you can get your bill online. So now you've got to go to your URL, type in your username, password, and then you download it. You put it to a Dropbox folder, and how does that then correlate with all the invoices that you've kept? It is a difficult one, I have to say, but it's one that each person needs to identify that as a process and get comfortable with theirs. I don't believe, if I'm honest, that there's a one-step process I could talk to you through that will suit everyone. I think it's really understanding what type of way do you like to communicate with. If it's email, you may have a completely different approach to someone who is very much in love with paper, for as an example. So, but one thing I would highlight to you is make sure you get your administration. And this is kind of what I would be saying to you is make sure you get invoices for all your expenditure, and that the invoice itself is a good description. I'm constantly coming across clients that will say to me, well, the builder wanted to give me a receipt at the back of his fag packet style book, which basically said, here's a bill for £30,000 for refurbishment, and can you pay me into this bank account, please? And the issue I've got with that is anyone could have produced that invoice. I could have produced that invoice, and will HMRC kind of say, well, that's acceptable? Most times out of 10, what HMRC are generally looking for is a detailed invoice. So for £30,000, you'd expect a bit more, professional type of paperwork. And what you're looking for, to be fair, and it will come clear why I'm asking you to do this with your description, is to make sure that your builder puts exactly what they're writing, what they're doing in your property on the paperwork to support it. So if they are replacing a kitchen, replacing a bathroom, they put those very words on the invoice, because the words replace or repair should tell HMRC that these costs are allowable to put against your property income. If you just said refurb and £30,000, then HMRC have got every right to challenge, to say, well, we believe that some of these items will be capital in nature, and therefore we will take the full £30,000 out, and then you put that against your capital expenditure when you sell the property, which doesn't do you any favors at all. And that's why I would say having an invoice description on every single paperwork that you have from your builder is really important.
Yeah, it's great advice, actually. Yeah, I'm sure we've all had invoices from builder. In fact, I can remember a time when I didn't get any invoice at all from a builder. Fortunately, it was more than 6 years ago, but it's an important thing to remember.
Well, to be fair, we have it in our own building. So Louise, my wife and business partner, got some refurbishment works on some flats that we own, as well as the commercial building that we're trading from. And the builder that we're using did the exact same thing as I just described, right? So he tried to give us one piece of paper and said, I did some refurbs on this day, this day, this day. Here's my labor rate and some receipts for the materials. I'm like sitting there thinking, Louise, how on earth have you just allowed this to happen when we don't even know which property it is? And, is it a repair? Is it a replacement? Or is it some capital nature? Because we do have some capital costs that are coming in here. So guys, I'm not here to be preaching to you. It's something that everyone has got to work on a daily basis to get their invoices correct. But we've always got to be mindful of, can HMRC trip us up? And I think if we can be comfortable with that the fact that we've got paperwork in place, we can justify why we've allocated expenditure in our accounts to reduce our tax bill, then we should sleep at night. It's just when you get your builders that don't give you the information as you would require. And talking about your paperwork and getting things in place, a lot of people will try and offset their car against their property business or trade business, and in rent to rent, no different. Now, the one thing I would always say is get yourself a mileage log of all the trips that you take. So if you're traveling to see a estate agent, or your joint venture, or you go to a property network event, or you're going to an education event as well, then all of those journeys will be allowed from tax purposes to offset against your income. And you could charge your company 45p per mile for the first 10,000 miles and 25p thereafter. So straight away, if you did 10,000 miles in your car, that's £4,500 worth of cost against your business, as an example. So it's a lot of money that you need to be thinking, well, how can I offset that against my business? Well, just get yourself a log that says, on this date, I travel from there and back to see this person or to see this event. And a lot of people that we see will take their joint venture partners with them, or their spouses, or if they're in partnership together. Please do note down here that there's an extra 5p per passenger allowance as well. So if you've got two people in your car, it's no longer just 45p per mile, it's actually 50 pence per mile, which means if you did 10,000 miles, that's quite a lot more cost that you can offset against your rental business.
Oh, very good. And if you had two passengers, presumably an extra 5p again.
Yeah, and I put this slide in because I just wanted to get your kind of gauge. Is this what you're doing yourself, John, in terms of, do you try and offset your car costs against your property business, or do you go down the mileage route?
Not really. I mean, I don't do any mileage for my property business,
Right.
because everything's managed. So no, that's not something that I claim for at all.
Okay. The one thing I would say on that, anyone listening in, you can get mileage trackers now. So you can put it in your car and you press start, stop, and it will tell you how many mileage you've done, a bit like a taxi fare. And it would then create you a spreadsheet after the duration of time, let's say if it's a month or 3 months. And you would take that mileage tracker, put it into your Xero or QuickBooks or whatever system you're using, and it would automatically do your mileage for you. So
you're talking about an app for your phone, or is this like a physical?
Yeah, there's a couple of apps out there. So there's iClaimIt, which is a great tool for expenses as well as mileage. And I think Xero do their own as well as QuickBooks.
Right, very good.
Now, you may have recalled me talking about getting builders to send you an invoice. And the key 3 words I always think about when I go around a property is repair, replace, renew. These 3 words, funny enough, came from HMRC. Who would have thought that HMRC would have been a good marketeer using these kind of 3 RE words? But they basically said, yep, if you replace, repair, renew any items in a property, then they will be fully expensed, provided that the property has got a buy-to-let mortgage on it. Now, if you're doing rent-to-rent, you're a little bit trickier because you haven't got a buy-to-let mortgage. But ultimately, what you are doing is typically you're not doing much capital work, especially if you're doing rent-to-rent. You're not going to look to spend 20, 30, 40,000 pounds on capital expense to improve that property because ultimately it's not yours. So why would you do it? So in that regard, as long as you can go around the property and say, well, I've got these kitchens that I'm replacing, straight away that should be telling you, yes, I need an invoice from my builder to say these kitchens are replacement items. And if he's then going around the property to renew your plaster work and your painting work, then again, he puts those very words on his invoice or her invoice. And that's really important to make sure that you go around the property. Can I repair these items, these cupboards, wardrobes that are falling apart, the tiles? Can I repair those, or do I need to replace them? And if you do one of those items, then you can reduce your property income. And to be fair, you said, where did I start? And to be honest, when I was as an employer, I did not want a lot of property income, as in profits. So what I used to do, I purposely would find properties that needed about £15,000 worth of refurbishment costs, knowing full well that I would only make £300 worth of profit per month. Not because I'm just after the capital appreciation, but to be honest, I want to keep my tax bill down. So I would constantly buy one property every 6 months that needed a lot of love and care, and I could do some refurbishment works on it. And it worked a treat because I didn't pay tax on my property income for about 8 years, funny enough, following this very strategy that I'm talking to you about now.
Oh.
Now, some people may even look to replace single glazed windows to double glazed, maybe not for rent, but you may come across a property that if you're managed to get a property and the rent is like, say, £400 a month, but you know full well that you could rent it out for £5,500 or something like that, then you may even want to look at the heating systems that you've got on there, especially if you're paying the bills. One thing I would say about anyone doing HMOs, rent-to-rents or anything like that is one of your biggest costs will be your utility costs. And if you could get in your good insulation in the first place by changing some of the windows, which sounds like it's going to be quite costly, but if you've got a long-term game here, then you've got to look at it as a long-term plan as well with that property, especially if you're doing a rent-to-rent and you get an option in place as well. So, that person couldn't sell that property from underneath you if you've got an option in place to buy it first. So that's something else you might want to look at. But what I would always say is items whereby you're improving the insulation of your homes. Don't look back and say, well, no, that might be too expensive, because actually the long-term gain of reducing your heating bills may be worth it. The key thing about all of these items, again, they are replacement items, and therefore they can be offset against your property income. So you get a kind of a win-win. So single glaze to double glaze, most accountants will say that's an improvement. Yes, it is. But in tax law, it is allowed because all it's doing is stopping the wind and the rain coming into your property. All the boilers and the fuse box is doing is producing heat and light. So the fact that you've gone with a bit more of a modern fuse box, actually it isn't an improvement cost because it's still carrying out the same function. So all those three items, as you can see in this diagram, are allowed to be offset against your property income, irrespective of what your accountant might say to you.
Okay.
So just some examples here. I just thought I'd put these together for you. So this is on the left-hand side, you can see there's a 1970s kitchen, which is typical when you're doing a rent-to-rent on an older couple. And what you'll notice on the right-hand side is that it's pretty much the same kind of layout there. But what you'll notice is that they've got new cupboards in there, same size, not much difference. You could argue that it's not that much modern. It's just, all it is just taking the latest thing from Magnet there. And all of those costs, it will be 100% allowable to be offset against your property income, because all you're doing there is replacing the existing 1970s wood chip kind of cupboards that you got there and replacing it with a bit more of a modern style-esque kitchen. So if that kitchen costs you £400 to put in, then that £400 would be offset against your property income. However, this would not be allowed. So this is whereby you're taking a property like on the left-hand side still, but what you're doing now is, because you're using your rent-to-rent as a HMO, clearly you need a bigger kitchen. You're not going to get 6 people in the left-hand kitchen. So what you might do is you might knock through another wall and take up the space whereby it may be used as a dining room. So you might use now a kitchen diner to create more space. Now, unfortunately, because of that, you are totally modernizing the existing kitchen, and therefore none of those costs would be allowable. In fact, would be capital. And the problem with capital items, it's not offset against your property income, it's offset when you sell the property on. Now, if you're doing rent to rent, you're not going to benefit from that, because ultimately those capital costs will be only beneficial to the landlord that put it in place. So unfortunately, if you are thinking about doing huge development costs, what you have got to think about is, well, if I've got capital costs in nature, I'm building extensions, not that most of you will do that, but in this example, you've knocked through another room, or you've got en suites in your property, then none of those costs will be allowed for you against your property income, nor will it be allowed to be offset against your capital expenditure either. So you do need to be careful with how much work that you do. Would you agree with that, John? Is that something that you've seen, your clients are doing?
Well, this is a kind of, these are kind of new considerations to me. I've never personally done any project like that, so is new to me. But it's good to know, and it kind of makes sense, But I guess if you're doing a rent to rent, then it better be if to spend that kind of money on it, it better be extremely profitable.
Yeah. To be fair, I have seen a lot of people doing rent to rents, and they've probably paid too much money for the refurbishment, John, if I'm honest. And I've always said to clients, you're crazy. You're not going to get that money back if you're not, if the guy pulls it from underneath your feet, says, thanks very much for doing up my property. How tight is your contract with them to stop them from putting the wall from underneath your feet? So you do need to be a bit careful with what you're doing. But as I mentioned earlier, these items are not allowed as well. So as rent to rents, if you're doing an extension, not that you're likely to, but we do need to think about it. If you're putting in a new bedroom, for instance, I do know someone who's doing this in Nottingham. Interesting enough, they were doing a rent to rent from someone who's had a big 4-bedroom house, and with their permission, they said, "But I want to build this into a 5-6 bedroom house, and I'll put it back to your 4-bedroom house after I've done." And the guy said, well, yeah, fine, do it, because I didn't want the property hassle anyway. So he created a 6-bedroom house. Now, that's fantastic because they can generate more revenue. But the type of work they was doing, again, would be capital in nature because it is adding value to the property for all intents and purposes. And it's not replacing any item, it's not repairing, it's not renewing items, it's actually creating new. And any new items for this perspective is always going to be capital in nature. So you can't, unfortunately, offset this against your property income.
Mm-hmm.
Now, what I have done for you listening into me tonight, I've provided John with a tax pack. So John can supply you with the allowable costs. What it tells you on that spreadsheet is it's basically trying to help you to identify, is it capital in nature, which isn't going to be allowed for rent to rent, or can I offset that against my property income? So it tells you every type of property refurbishment that you're going to be doing in each of the rooms in that property. And it will tell you this item could be offset against your property income. This item needs to be capital in nature. But it also gives you a VAT rate as well. I'm not sure if you can see that on this picture here, but you will notice that this number is certainly smaller than this number. And that's because there's certain types of properties that you can reduce your VAT from 20% to 5%. And if you wanted to know more details about that VAT reduction that I talked about earlier, there's a link in that spreadsheet as well. So it will tell you exactly how to help you reduce the refurbishment costs, in particular, the VAT that you'll pay on it.
Very good.
So let's take a look at section 24. Now, this is always an interesting one, and I was half debating, should I put it in, should I not put it into a rent-to-rent, because, well, let me come on to why later on. But let me just give you a bit of an overview of what section 24 is all about and how it's going to affect people in the future. I'm going to move myself and John out of the way for a second. Now, I'm talking to you because you may have properties in your own name as well as having rents. But it should be a fascinating just to go through this example. Section 24 is mortgage interest relief cap. So what the government decides to do is not allow the mortgage interest cost to be offset against your property income. And what I've done is demonstrated this by showing you Jane, who's a high rate taxpayer, and you've got the budget before the budget announcement. So 16-17 is before section 24 came in. And then you got after the budget changes came in, which is 2021. And what I've done here is that you'll notice I've made direct comparisons between these 2 years I want in question. Now, the income's not going to obviously change, but what you should be picking up on is that £8,000 worth of mortgage interest costs was allowed in the 16-17 tax year, but isn't allowed in 2021. What that means is, for poor old Jane, is that currently she's running this property at a £1,500 loss. Now, there are a lot of people out there that are employees that look at property as a capital appreciating asset and therefore not too bothered about if they make a bit of a loss on their property. Crazy thought, by the way, but this is very true. This happens quite a lot. After the budget changes, though, poor old Jane is going to go from a loss of 1,500, which she's expecting to see every single year, and HMRC are going to say, no, we're going to tax you because you've made a profit of 6,500. The difference between the 1,500 loss and the 6,500 is nothing more than the £8,000 worth of mortgage interest costs, which is now being removed. So what does this say for Jane? Well, Jane, bless her, in the 16-17, clearly, if you're making a loss, which that loss can be carried forward for ever and ever until it's been utilized up, will not pay any tax. However, the same scenario is whereby we're now full flow in section 24, 2021. She has made a paper profit of 6,500 and she's got to pay £2,600 tax. But, you know, HMRC are very generous, aren't they? So they gave her a 20% tax relief on those mortgage interest costs, which still means that she's got a tax bill for this property of £1,000, even though she's making a £1,500 loss on the property. And now she's got a cash flow out of £2,500 just to keep this property going. Now, it'd be interesting from your side, John, because obviously you're in Arizona right now, but you clearly have UK assets. Is this the kind of picture that you're seeing some of your attendees worrying about on their tax returns?
Um, well, yeah, I mean, there's definitely concern out there. But I think people are still a little bit foggy about exactly how it's going to affect themselves. But yeah, it's good to see an illustration here of how it's going to work. It's not a pretty picture, is it?
It's not, no. And I think the one thing I would say is that the NLA produced a report that basically said that 65% of landlords still do not know what Section 24 is, never mind how it's going to affect them. So whenever I put this slide up, it is a quite a pictorial evidence that Section 24 is going to have a negative effect. I mean, we've got clients that has got a tax bill of 145% of the property profits, which, you know, if this guy made £20,000 worth of profits, he's giving that and a lot more to HMRC. So he's not making any profits at all on his property income because of Section 24. And this is why I want to get it in there, because the big thing for me is that the Section 24, I would say, yes, it's a serious issue right now because 2021, 22, it's coming quite quickly. But I think there's also a Section 24 compound effect, because right now the interest rates are really, really low. But if the more that increases, more interest is going out of your bank account, but you're not getting the tax relief on it. So I think as we're going through the phasing of Section 24 coming in and the inevitable increase of interest rates, we will see a more hurtful effect of Section 24 coming on board.
Yeah, definitely.
And this is one of the things that we do for our clients, interesting enough. So we will take an example. This is an additional right taxpayer, so someone who pays 45% tax. Now, what we was doing for this client and all of our clients, interesting enough, is year by year is saying, well, if you've got your property profits of £35,000 and that continues in the same vein, with the same amount of mortgage interest cost, even though we know it's going to increase, we are now indicating what the amount of property tax is going to be against that profit. And as you can see in this example, this person has got a shocking 45% tax bill, but actually by 2021, their tax bill is now 88% of their property profits. So we do this for every single client to help them understand, well, if you don't do anything, then this is going to be the tax liability that you will likely to face. However, I don't like to be glass half empty. One of my mantras is try and find something that's even better than the situation at hand. So like many accountants, I'm sure, we went away and we investigated how we could avoid Section 24. And interestingly enough, service accommodation, holiday lets are bang up there in terms of avoiding Section 24 because it's not a residential property. Holiday let service accommodation is, for all intents and purposes, is a trade and therefore doesn't have the stigma of Section 24. And you'll notice that there's a lot of people, especially in London, albeit that's been curbed now with the local authority squashing the use of holiday lets use class. But ultimately around the London area and indeed Dorset, those kind of areas, we are finding that there's a lot of people now using the rent-to-rent strategy, but rather than rent the property out as a HMO, they would rent it out as a holiday let or service accommodation, which means they can generate an awful lot more rental income. And that's great for those because anyone who's doing rent to rent obviously is not going to be affected by Section 24 at all. And that means that they can use these, as holiday let service accommodation, generate even more income. So there's a double whammy in terms of how to avoid that tax. Having no mortgage, well, rent to rent, you don't have a mortgage, do you? So that means you're scotch-free. But I would also say to people, maybe having no mortgage on your property portfolio is probably a good thing and a sensible approach going forwards anyway. Like me, many property investors will get a mortgage in the vain hope of capital growth. And that actually worked really well for me in the 80s and 90s, where capital growth was really doing well. Now you can see that the capital growth isn't doing so well, especially with concerns of Brexit and various other uncertainties. Are we going to see that capital growth? And therefore, is it better to have 4 properties or 1? My view right now is to have 1 property. I have less tenants. I have, paying off my mortgage means I don't have to answer to the banks, and I could do a lot more IHT tax plan as well. Last one is obviously you can put losses. So if you've got losses in your property portfolio right now, then Section 24 clearly cannot affect you, because if you've got a loss, then a loss is taxed at 0%. So Section 24 may not affect you, but again, as I said in the earlier slide, it could be a compound effect where your losses are being withered away quite quickly because of Section 24, mortgage interest rates are going up, and Section 24 is being phased in. All of a sudden, you could be faced with a huge tax bill without realizing it in the 4th year, 2021. And we do say to a lot of our clients, buy properties in a limited company. Now, we say that because if you don't need all the money from that limited company and you're happy to kind of reinvest, then the tax rate in a company is just 19%. So it makes a lot of sense sometimes to use a limited company, albeit I appreciate that subject in itself is a webinar all on its own. So we're not going to go too much detail about that tonight. But hopefully, John, you can see some of the mitigating factors that people can take. Is there anything in that list that you kind of think, yeah, there's a few of my guys that could use these strategies right now?
Yeah, definitely. I think people are looking at the certainly service accommodation that's very popular right now as well. And as you say, that takes away the it's not residential anymore, and that takes away the Section 24 risk completely. So definitely.
Good. And whoops, no, I'm not sure we've done that. Here we are. Yep. Now I've gone quiet. Can you still hear me, John?
Yeah, I can hear you.
Perfect. Sorry, I just went off. So one of the things I noticed still on this one is rent to rent, not for you, but what about your landlords? And this is probably where I'm going to delve into Section 24 and in particular you running rent to rent businesses. You may sit there and say, well, Section 24 doesn't affect me at all, so I'm sitting here quite comfortably. But what you have got to realize is, well, the person that's renting the property to you, they could be a high rate taxpayer because of these changes. And therefore, the Section 24 does affect them. They may pay more tax. What are their choices? And that's something that you now need to start thinking about from a positive perspective. I keep getting this out of the way. Let me do a couple of things that landlords can do. They can sell the properties beneath your feet. We've seen already some situations whereby the owner of the property has put the house on the market, and before you know it, they're giving notices to the tenants to vacate the property. And unfortunately, this was a rent to rent, and they're kind of asking us for legal advice. Now, we can't give legal advice. We're accountants and tax advisors. But they spoke to their solicitor, and they said, well, albeit you've got a rent to rent contract in place, if that property is now owned by someone else, you may as well rip it up, because you've got an agreement on an asset that no longer exists. So it can be problematic. You do need to think about that. But what I would say to you is that an opportunity for you to buy those properties? So if you start talking to them now and saying, well, Section 24, do you realize what it is? They'll probably say no, burying their heads, like many landlords. If you advise them properly and say, well, actually, these are the kind of things that you need to be watching out for. Are you at risk that Section 24 might come into effect? Watch the blood drain from their faces, and you say, well, let me take that problem away from you. There are a lot of accidental landlords. That's why they're using your services as rent to rent. They don't really want the problem. They don't want all the hassle, and happy just to have minimum amount of fuss whilst you do the rent to rent deal with them. But it is an opportunity for you to think about, well, can I buy that property from them? Or indeed, could you sell that asset to another investor, maybe using a limited company, and you still do a rent to rent with them? I think it's something that I would say to you right now is be proactive and speak to the landlord now. Get a feel. What are they likely to be doing? What's their headspace saying to them? Are they going to make a change? And if that's going to be a change, how will that affect you? And can you do something about it?
Mm-hmm. Yeah, absolutely.
So we're going to talk about limited companies now. The one thing about limited companies is structures. So we mentioned earlier that even for rent to rent, you may want to use a limited company. And the reason for that is because you want to minimize the amount of risk. If you've got properties that you're doing rent to rent in your own name, then the liability is with you and it could affect all of your assets. So one of the things that you might want to use a limited company for is not just for tax planning, but it's also for risk mitigation as well. So again, if anything should happen to a tenant, someone dies in that property, then the liability stays with that limited company. It cannot affect your personal assets. So from a risk perspective and tax planning, that's why a lot of people use limited companies. This slide in particular is just showing you how much money you can take out of a limited company tax-free. A lot of people will sit there and say, well, actually, the personal allowance is only 11,850. Well, that's true, but you do also have this extra £2,000 worth of dividends that you can take out of your limited company, which means, in effect, you can earn £13,850 without paying anything to HMRC, and that's got to be good news for everyone. If you take more money out of your limited company, if it's making better profits than the 13,850, then you need to be aware that as a basic rate taxpayer, you will be paying 7.5% tax on any dividends distributed to you. As a high rate taxpayer, that is increased to 32.5%, and then it goes up even further to 38.1% as an additional rate taxpayer. Now, if you're an additional rate taxpayer, one thing I would say to you is that you've paid corporation tax of 19%. So you've got to add those two numbers together to work out what the total tax has been for your company and for you as an individual. A couple of other things that you can do with a limited company. These are the things that people don't really talk about, but it's something that I'm always preaching to my clients, is that your limited company can contribute towards your personal pension. So albeit you're looking to have properties, I would say that it's a good idea to have pensions because it allows you to reduce the profits of your limited company, which means pay less tax. You're getting the money out of the company into your own personal estate again. And don't forget that you can use money in a SIP or SAS pension to buy even more properties anyway. So it's a very good idea to invest in your personal pension and to reduce your tax bill at the same time. There are ways of paying for private schooling through your company as well. That's being pretty much phased out nowadays, but there's still opportunities for you to pay for after school care through your limited company using someone like Eden Red care vouchers. And those care vouchers would be allowed to be offset against your income in your limited company. Paid medical treatments. For anyone over 40 listening into this, you should be seriously thinking about having a well person check done every single year. Our health deteriorates as we grow older. So it's always a good idea to book in a medical checkup. And those medical checkups, that are private doctors, will be allowed to be offset against your limited company. So another bonus. Everyone likes to celebrate, and why not? It comes to Christmas, or you have a great event, or you do record profits in your rent-to-rent business, then why not celebrate by taking your staff out, and you can go to a nice restaurant and pay up to £150 per annum per person. So you can only do it once, really. And that, as long as it's not over £150, none of that will be a tax benefit. It can be offset against the company's cash as well. So it's another way of getting money out of the company to treat you as a director or shareholder. Your limited company can also pay for life insurance. So if you want to pay out on your death, then your company can do that. And you can also give up to £300 worth of vouchers to be given to your employees. Now, as employees, it's unlimited, but most people that I speak to are directors and shareholders of their own company. So there is a limit of £300 worth of gift vouchers that can be made to your directors and shareholders. And what I would be saying on that to you is don't buy £300 worth of vouchers all in one go. What you've got to be doing there is it's £50 vouchers, and you give those over to yourself once every month or so. And those vouchers £50 or under, again, would be allowed to be offset against your company profits and therefore reducing tax, but it would not become a tax benefit in kind to you. So no need for you to pay income tax on those kind of items. Lastly on here is Perkbox. So Perkbox is an app that sits on your phone. Your company will pay maybe £7.50 towards it, and it will get you high street voucher discounts. So John Lewis, as an example, I think it's 5 or 6% discount. You get free phone insurance using Perkbox. You can go to restaurants, and most times you can get between 5 and 15% off those restaurants. So hopefully I've demonstrated many ways of extracting not just cash out of a limited company, but other kind of good items as well. Were you aware of all of these items, John?
I certainly wasn't. No. Yeah, life insurance thing, the gift vouchers. That's that's all new to me. I'll have to check Perkbox out as well.
Yeah, Perkbox is really good. I love it. It's one of those things that you can combine. You can combine these items as well. So if you get a £50 voucher from your company, which your company pays, you don't use that on Perkbox. So John Lewis vouchers, and instead of just a £50 voucher, which has come from your company, so it's free, you can get items for about £56. So, combining those to a really, really good way to reduce your own lifestyle expenditure, I would say, by using the limited company. Brilliant.
Yeah, fantastic.
Some of the things I would say to anyone thinking about using a limited company, and I would say that I've had several conversations with our clients about people that use limited companies. And I say, well, at what point is it worth me using a company structure, and what point is it not worth it? And this is a quick example that I gave to a particular client and said, well, imagine on the left-hand side, you had all the income in your name. I'm going to ignore national insurance for now. This one is if you've got trade activity, but we're talking about property, so let's just stick with income tax right now. And if you've got £100,000 worth of revenue in your name, and this is ignoring Section 24 as well, but your income tax bill of having that level of income is £28,350. Now, if you compare that in a company, same £100,000 worth of profit, but you extracted £100,000 out of that company, if you go straight to the bottom there, you'll see that the total tax is actually $36,761, which is actually more than the $28,350 if you left everything in your own name. Please do note that even though I'm showing £8,000 worth of saving, because of Section 24, it's unlikely to be that much saving in terms of tax. But what I'm trying to show to you is it's not always tax beneficial to have a limited company if all you're going to do is rip every single penny out of it. Where it does work is whereby you've got a company that's generating £100,000 profits, the same numbers, but instead of extracting that £100,000, you're only extracting £50,000. The amount of tax that you'll pay is now shaped down to $20,511, which is less than the personal tax by £8,000 by minimum. So you've got to think about, and this £12,000 savings is if you've got a national insurance charge. If you're obviously running property, your total tax is actually just $28,350 versus $20,000. So you're only saving £8,000, but I tell you, £8,000 worth of saving is a lot to be said. So always take advice before you set up companies, and make sure you think about the future as well, because we've even had clients whereby they've set up a limited company, and after 2-3 years, they've given up their high rate tax paying employment job. And as a result of that, I would have been saying, well, if I knew that in the first place, I would have told you should have the property income in your own name. Because when you have a limited company, you are likely to have more fees because of accountancy fees are going to be higher. But more importantly, if you've got buy-to-let properties in there, and you have got mortgages, then you're paying between 1 and 2% more interest rates in a company than you would in your own name. So sometimes we are asking our clients, well, how long are you going to have this company? Is it going to be for 5 years or more? And if they turn around to it and say, well, actually, no, I'm going to give up my job in the next 2 years, then I would have said, well, actually, just keep the properties in your own name and do what I did, refurb a lot of properties for the first 2-3 years, build up your losses, and when you do eventually give up your job, you've now got a property portfolio that could sustain you, and hopefully keep you as a basic rate taxpayer and keeping down your accountancy costs as well.
Yeah, good advice.
There's a lot to be said on that one, isn't there, John?
Yes.
But I do think it's worth speaking to your tax advisor before you jump ship. I always find that people will attend a networking event or they'll go to a Facebook group, and the big thing will be, well, I'm using a limited company, so should everyone else. And unfortunately, that's not true. It only is really beneficial for people that it's going to be a tax benefit to later on. So that kind of brings me to a wrap, John. So I don't know, maybe I'll leave it on the slide, but is there any kind of questions that you had or kind of clarification points that we should be discussing?
Well, that was all pretty clear, Simon. Let me just check my little list here. Obviously, it's a pre-record, so we don't have anyone on the call to ask questions. No, I think that's it really. I mean, all I would ask is maybe, obviously Section 24 is something that, we've been hearing about, people are becoming more and more aware of, but are there any other kind of things like this, coming down the line that in the future that people need to be aware of, or any other kind of tax considerations that are going to come out the woodwork in years to come?
I think there will be. I think that's inevitable. I think the whole idea of making tax digital is on its way as well. So a lot of people that are using Excel spreadsheets, they're going to have to use something like Xero or QuickBooks or something like that, so that they can send to HMRC their quarterly tax returns, which is going to come into effect maybe in the next 2-3 years' time. So that's the next big thing for me. I don't think there's going to be major tax changes, if I'm honest. I do think that there's going to be an attack on furnished holiday lets and service accommodation, because HMRC are already seeing a lot of people now using those vehicles to minimize Section 24 and increase the amount of profits that they're making. So clearly that's an area that HMRC will start to look at and say, well, how can we generate more revenue for the government? So I think there will be a knock-on effect there, but I think making tax digital is probably going to be the major one, because most people using spreadsheets, or most people telling their accountants on the 30th of January, what their income and expenditure is by a bag full of receipts. You're not going to be able to use making tax digital work, because you need to do it on a quarterly basis. So I think there's going to be an overhaul in terms of how you manage your business. And I always say to people, if you're not managing your income and costs on a monthly basis by using some sort of accounting system to see how well you're performing, then I don't think you're really in business at all, because there's just no way of knowing, are you making profits or not? So I think making tax digital is a negative in many ways, because it's more administration, but I'm hoping that it will professionalize the industry to make landlords start to look at their numbers a lot more closely.
Mm-hmm. Yeah, that's interesting. It's good to know that that's on its way as well. Okay, well, that's been very interesting, Simon. Thank you so much for being with us. I think the listeners are going to find all of that very interesting, and well, perhaps some of it a bit scary, but at least you've covered some good ways of mitigating the Section 24 changes. So yeah, just before we wrap up, if you'd just like to tell people how they can get in contact with you and where they can find you online.
Yeah, so well, I'm always on Facebook, so make sure you add me as a friend on Facebook or LinkedIn if that's your preference. But you can, like I say, we've got plenty of articles about Section 24, rent to rent as well. It's on there. So you can go to www.optimiseaccountants.co.uk, and we've also got, because I know I've been doing this webinar with John, you can also use, if you've got an accountant and you're happy with them, then you can book a tax call with us using the code JWP25, which is 25%. You can get that discount off of your tax call. And if you wanted to, you can book some time on just yourself. You can book some time in with your accountant or your joint venture partner. It's really up to you how you want to get the best solution for your tax planning in 2019.
Brilliant. Okay, well, thanks again, Simon, and we'll speak to you again soon.
Thank you, John.